By the end of this session, you should have a good understanding of the purpose of interest rates, the difference between the nominal and real rate, the concept of the Monetary Policy Committee in the context of the Bank of England, the various determinants and theories behind the structure of yield curves regarding interest rates. We'll touch on the traditional theory of why interest rates are set, and then we'll also explore the concept of interest rate risk. As you can see from this topic map from your core textbook, this is chapter 3 and it's from page 55 onwards. These are the elements we're going to cover within this session. So following this lecture, you should have a good read of this chapter to make you fully informed of the concepts that we have discussed. So what is an interest rate? Well, when we're talking about the base rate, or the rate that's set by central banks, then this is a crucial economic indicator for the economy. There are a lot of elements that factor in to what the interest rate should be in an economy. The purpose of interest rates, certainly from a UK point of view, is to set to control inflation. Like most Western countries, the inflation target is 2%. This is that economies want to grow. They want wealth to be generated, but they want that to be generated sustainably. So if inflation is 2%, inflation is the price of goods, and if the price of goods is going up by 2% every year, then that will be reflected in income and wages. Thus, the economy and its people becoming more prosperous and more wealthy. Therefore, 2% growth is seen as wealth generation. And we can use interest rates to control that. Because the interest rate is a key component within the economy, it influences the likes of consumer spending, consumer saving. It depends on whether businesses are going to invest. Can they borrow at this interest rate to invest in their business and become more profitable? So there are a lot of reasons behind the interest rate setting and why it's so crucial for the economy. Essentially, if interest rates are far too high, nobody can borrow, which doesn't generate wealth. People potentially can't pay back loans and may go into default and face the consequences of that. If interest rates are too low, then people may borrow far too much, and that could also be an issue when interest rates start rising. But low interest rates typically are set in recessions so that people do borrow more and try to kickstart the economy, for instance. So what is an interest rate? Well, according to economic theory, it's quite simply a price, a return, for borrowing funds. And you're borrowing that from a lender. So if we look back to lecture 1, we talked about the financial system, getting funds from people who have it to people who don't, to allocate resources efficiently. How do we price that allocation of funds? You can price it via an interest rate. Of course, interest rates differ on various products and who the lender and borrower are, but the main concept from a theoretical point of view is the difference or the reason that interest rates change on different products depends on the length. Typically, if you borrow for longer, it costs you more. There's also economies of scale concept. It's cheaper to issue one large loan, rather than issuing 10 small loans. So economies of scale. And then there's also the various degrees of risk. The risk to the specific product, the risk from the lender, the risk from the borrower, and also inflation risk. There's various types of risk, and you'll certainly cover the majority of them throughout your degree. So what's the difference between nominal rate and the real rate? Well, interest that you normally see, and what I normally see, is the nominal rate. And the nominal rate is what's calculated using the formula actual number of days, in this case, divided by 365 for the UK. So it's really for calculation purposes. So in the UK, we use 365. In the likes of Japan, they also use 365. But markets such as the Euro, and the European region, and the US use 360 days. So the nominal rate of interest is really for mathematical purposes and allow for some kind of conversion dependent on if it's an overseas transaction. But the real rate is the rate of interest which is measured on the anticipation of opportunity cost from the lender. In other words, the real rate is the deferred consumption from the supplier of the funds. If you think about it, if you have money to lend out, if you lend it out, you're deferring your consumption. You're not going to buy it. So if you're going to lend it out, then you need to lend it to somebody, and the market, via equilibrium, supply and demand, needs to find a price. If you potentially say, I'm going to lend out my funds at X amount, but that's far too high, nobody wants to borrow it, then you're going to sit with them funds and you're not going to potentially borrow it out, and therefore you may face the inflation risk of that cash sitting doing nothing. But if you lend it out at the market rate, an equilibrium between the suppliers in total and demanders in total, then that equilibrium is the real rate of interest. Typically, in the UK, when we say the real rate, we're also referring to the base rate, which is set by the Bank of England. So, let's look at a few more reasons why interest rates may differ, or the reasons for interest rates. The first one, as I mentioned before, was deferred consumption. Deferred consumption is the concept that humans, we like to spend. We like to consume now rather than later. And if we are deferring this consumption from buying something we need or something we want, then we have to be compensated for that. We don't want our money to erode due to inflation. And that leads on to the next one, inflation expectation. As I noted before, we like to have an inflation target in the UK of 2%. Therefore, if we're going to borrow out our money to consume later, we want to make sure we return higher than 2%. Because if we look to consume in a year's time and we haven't been compensated for this, our purchasing power of the money we have is slightly less. So you might have deferred consumption, but then we can't actually buy the level of goods that we could have a year ago. Thus, we need to charge an interest rate above inflation to take it into effect the time value of money. Between different products, we potentially offer different rates to take into effect that we have consumer choice. Borrowers can potentially shop around. They can not only look at different companies, but they can look at different products within them companies. Therefore, from a kind of marketing and competition point of view, interest rates will vary depending on demand from the consumer. And also, on larger scale, these loans may be negotiable. Thus, if you have a supply of funds, then you want to be competitive and be open for potential negotiations for interest rates on the amount of money that you are willing to lend. Of course, the next one, risk. This could be any risk. It could be credit risk, liquidity risk, market risk, operational risk. Whenever you lend out money, you have to price in the risk of not getting that back. That's mainly credit risk. But you also need to price in the fact that there could be fraudulent reasons for operational risk. So you will potentially credit score the person that's going to borrow the funds from you to ensure that they're going to pay that back. And if the credit risk of the counterparty is too high, you may not lend to them in the first place, but if you do, you'll charge them a higher rate of interest because of their credit rating. And then lastly, we have the concept of liquidity preference. From a behavioural point of view, we like to have our cash in cash form, very liquid. If we borrow out, then that's a loan, and then if we want to get that back, we either have to recall it or potentially sell that loan on to someone else to administer. Therefore, if we give a loan, then we're deferring that consumption for a while. We're not going to get our cash back for a while, depending on the length of the loan. Therefore, we charge higher for longer dated loans. Now let's have a look how we can potentially chart this formula for working out the nominal rate of interest. As I mentioned before, the nominal rate of interest is the one that we use to calculate and potentially the one the consumer sees. So first of all, to start the formula, we have the real rate. So the theoretical rate between supply and demand. In the UK, we'd like to say that's the Bank of England base rate. So the first part is the real rate. And on that, we add expected inflation. So again, if you potentially say the current base rate at the time of recording is 0.1 or 10 basis point. Expected inflation, we can use the target of 2% there, or 200 basis point. So already we have I of 210 basis point. As you may have known there, I just used the target for inflation. You could use the actual inflation rate at the time of when you do this calculation, or you could just stick with the 2%. On top of this, we have to add liquidity premium. Now this is more subjective. Liquidity premium, as I mentioned before, the longer you lock in something, the more you charge. So this is more of a curvature. So it is a short-term loan. It's not going to be so high. But as the loan grows in length, maturity, then liquidity premium is going to also increase. And on top of this, we need to take into account market risk. This could be any form of risk under that. So credit risk, operational risk, liquidity risk, all factors into the concept of risk. And depending on who you're giving the loan to, the risk might be specific to them. So if we plot this on a chart, we've got time in years along the bottom, we have interest rate up the side, we have the real rate at the bottom, so this could be the 10 basis point at the minute. And on top of that, we add expected inflation, so this could be 200 basis point, 2%. Next is liquidity premium, and as I mentioned, the longer you lock in, the more it will increase. But notice it's not a straight line, it is more of a curvature. And then finally, at the top, we add on risk premium. And from this, we end up with what's known as the yield curve. Within this formula, it is very difficult to decompose when you see an interest rate, what is liquidity premium, what is risk premium. Obviously, we can kind of get an understanding of what the real rate is and what expected inflation is, but it's very difficult to decompose the other two components when we're working out what is actually in that interest rate from this formula. Within this formula, there are various theories that also determine its shape. So we have expectation theory, liquidity preference theory, preferred habitat, and market segmentation theory, and we'll cover these shortly. But the top one, the risk structure of interest rates, that really links into the concept of the top line, why interest rates change depending on the level of risk with the counterparty involved. This risk structure is really like the graph I've just shown you, where we plot time along the bottom and interest rate up the side. And for every given time horizon, we look at what the different level of interest is. But obviously the yield curve that we've just seen doesn't include some of the stuff like information costs, taxation. We try to account for risk, of course, in that. But obviously, how do you determine risk for certain individuals at certain lengths of time? How do you determine the risk of an individual if the loan was 30 years long? What's their position going to be in 30 years' time? We assume in a perfect world that if you're getting a loan, you're doing that to generate wealth and make yourself wealthier. So you're kind of investing now for the longer term. So in 30 years' time, the person that you may have lent the loan to will be in a much better position than they are today. But obviously we can't account for what's going to happen in 30 years' time. Thus we charge more for longer dated loans. Therefore we call this term structure the yield curve. And this yield curve shows the relationship between different time horizons and the interest rates for them products. This yield curve could be for a specific company or specific country. For instance, we could look at the UK sovereign debt yield curve, which is the yield curve for government debt. You could potentially look at an organisation. If they issue lots of bonds, then you can potentially look at the yield curve for individual organisations, and you may see how much steeper they are given that they don't have a higher credit rating, such as a sovereign wealth. Now, there are various different types of yield curves in forms of shape. Traditionally, we discuss in textbooks the likes of the normal yield curve. In times of growth, you'd expect longer-term debt to be more expensive than shorter-term debt. So in positive times and growth periods, you'd expect the yield curve to be normal and curve upwards. But then it can go to humped. Humps typically happens when investors get a little bit nervous about the economy and potentially expect interest rates to start dropping. So therefore, if they think interest rates are going to drop in the long term, then the longer dated debt becomes a bit cheaper because demand will drop for longer term debt. Demand drops and there's still supply. That pushes the interest rate charged on long term debt down. And then from humped, you get something that's more flat. And this is where the likes of inflation starts to become into zero, or the inflation change starts to become negative. In other words, inflation is dropping. Then the yield curve will become more flat. Then ultimately, the yield curve will flip and will become inverted. And this is when we're typically in a recession and investors are nervous and they're more likely to expect interest rates to drop in the long term. Therefore, the yield curve will flip. So let's look at a real example. So I've got the yield curve from 2007, comparing that to 2014. Now 2007 was prior to the financial crisis when investors were getting a bit nervous and expecting something to potentially happen. And at this time, the base rate in the UK was up towards 5%. So what you can see in 2007 is the yield curve was inverted. And this is typically what happens when you expect a recession to happen. But also this happens when the likes of the money market instruments become more expensive because market liquidity dries up. So shorter term debt, less than 1 year, becomes expensive as liquidity drops. And lo and behold, interest rates following the financial crisis were cut severely. They went pretty much from 5% to 0.5% over a quick period of time. So if we fast forward 7 years to 2014, then 2014 was after the financial crisis, the European debt issue. This was kind of seen as a time of growth. So from here you can see the yield curve is more normal. It's obviously much lower. It's underneath the yield curve of 2007, and that's frankly because at the time the base rates were 0.5%. Compared to up here when base rates were 5%. Therefore, the R in the formula was much lower. So you can see 2014, a bit more of a normal yield curve. We can plot this yield curve on a 3-day timeline to show how the yield curve may change over time. The yield curve itself is just a snapshot on a single day, but what we can do here is we can put them snapshots all together in a 3D plane to have a look at how the yield curve changes throughout time. And you can see it doesn't typically move in parallel. Certain points tilt, certain time horizons go up while others remain the same. You can see there's gaps in the yield curve. So this is the UK sovereign debt curve. And what this is suggesting is at certain time horizons, for instance between 5 to 8 years, certainly back in 2014 region, they didn't issue this sort of debt, thus you couldn't plot it on the yield curve because this type of debt was not issued by the UK government. You can also see that the UK government typically doesn't borrow between 3 months and a year. Most of their debt is either less than 1 month or they borrow for longer from 1 year onwards. So in the short-term money markets, they don't issue certain products, certainly between 6 months and 1 year, they typically don't issue them sort of T-bills, hence the quite gappiness at the earlier dates. But if you think for the majority time of this graph from 2010 to 2020, base rates were pretty much 0.5% for the majority of this time. So what you can see, even though base rates were 0.5%, even back in 2010, it took a long time for the yield curve to actually get much lower. And this is because at longer dated debt, investors were potentially still nervous about the UK economy. and therefore longer term debt was still getting priced quite highly relative to the base rate because of the uncertainty of the economic conditions at the time. Until eventually, when we got to more of a growth period, or like I said, after 2014, 15, after the kind of European sovereign crisis issues petered out a bit or were resolved, then you can see the yield curve really started to lower, and therefore longer term debt became a lot cheaper as the prospects and the level of risk from a UK government point of view reduced. And obviously during this time, the UK economy was going through a range of austerity measures to also cut the level of government debt to try and put the government balance sheet and lower its deficit. So there's a lot of things that you could factor in on this yield curve, and you could talk about kind of theoretical concepts, the actual real world implications, and also the politics involved in this curve. But let's have a talk about the theoretical elements of why this shape exists. So the first concept is expectation theory. This theory is the concept that longer term rates are determined by short term rates. Essentially, if we believe the yield curve to be going up, then it will go up. If we expect short term interest rates to rise, then we expect long term interest rates to also rise. As part of expectation theory, if we expect interest rates to go up over time, hence the curvature upwards, then from an investor point of view, there should be an equal choice between having, say, 3 one-year bonds in a row or just having 1 3-year bond. They should return the same level of interest. So a 3-year bond that you just buy and hold, that should return the same rate if you got the 1-year bond, rolled it over the next year and rolled it over the next year, then you should return the same amount of yield. Because expectation suggests the yield curve or interest rate should go up in that pattern. Consequently, on the flip side, if you expect longer term rates to drop, that's because you expect short term interest rates to drop. So longer term rates do still follow short term rate changes. And then if you also expect interest rates to be constant throughout, then that's why it would become flat. So it's all about expectations, and that longer term rates follow the pattern of short term rates. The next theoretical concept is something we've touched on already, is liquidity preference theory. This theory is more behavioural. It identifies that investors in bonds are naturally risk averse. Therefore, if an investor invests in longer term bonds, they must be compensated for that because they're deferring their consumption much longer. Therefore, they must be rewarded, hence the upward slope. And it also has a major assumption that at different lengths of time, there is no other alternative. Therefore, you have to potentially just get a bond. There's no alternative, thus you want to be compensated for locking in to longer dated bonds because there is no alternative for longer dated time horizons. The next concept is preferred habitat theory. Again, this is very behavioural. The idea behind this is investors don't like going outside of their comfort zone. They like their preferred habitat. They like to invest in certain products that they understand the risks, the characteristics of the product, and so on. If you want them to go outside their comfort zone, in this case you might have a bond investor that likes investing in bonds of 5 to 10 years. If you want to compensate them for going outside their comfort zone and investing in bonds of 15 to 20 year time horizons, then you need to compensate them for doing so. You need to acknowledge the level of additional risk the investor may take and therefore compensate them for doing that. Just like liquidity premium or preference theory, rewarding customers for going outside their comfort zone. And the final one, which really contradicts expectation theory, is market segmentation theory. And this is essentially a mathematical concept where at different maturities along the yield curve, they have different supply and demands. So if you slice the yield curve up between shorter dated bonds, medium term and longer, it suggests that supply and demand in these three different maturity buckets are very different. And it says the likes of supply and demand at longer term bonds may influence the supply and demand of shorter term interest products. For instance, you may have a normal yield curve, but when you start getting humped, that's because the demand at the longer term debt lowers. As the demand for longer term debt lowers, where does that demand go? Well, that demand may shift to the shorter term debt. And if we look at the shorter term maturity bucket, then the demand for them products may increase. So if demand lowers at the far end of the yield curve, that'll push the end down. But if demand starts spiking at shorter term debt and supply remains the same, then the cost of shorter term debt is going to go up, effectively tilting the yield curve, and eventually could end up flipping it. So this is all about supply and demand at different points along the yield curve. Okay, let's move on and think what other potential interest rates are out there, or what are the various types of rates that you've heard of. On the slide here, we've got the likes of the London Interbank Offer Rate, which we will explain in more detail in the money market lecture, and the fact that this LIBOR rate is actually going to be discontinued from this year, and there has been various replacements from around the world that is now in operation. We also have the likes of the non-sterling LIBOR rate or the Eurobond. In the US, we have the Fed rates. From companies, we have company bond rates, we have government bond rates, and so on. If you go to Bloomberg and look on the Treasury and Money Markets function, BTMM, and select the country, we do get a snapshot of the various interest rates. So if we have a look at the likes of the right-hand side of this, we can see the Treasury bills, the T-bills by the Debt Management Office. So this is the short-term debt by the government. But then underneath we can see the gilt, which is bonds issued by the government. So essentially what we have down on the right is the yield curve. And interestingly, at the moment, you can see that short-term debt is actually negative. Now the base rate, as I said, is a 10 basis point. But if you invest in shorter-term debt, then you as the investor has to actually pay out if you're going to buy this product. So what message is that sending the market? If you're the investor and you buy a T-bill, you don't get any interest, you have to pay for it to hold it. Essentially that's telling you, do not invest in this product. Invest elsewhere, or more importantly, spend it to kickstart the economy. So at the moment, shorter term debt in the UK is negative. And this is something that hasn't been seen for a very long time, if not before. Please do look that up, certainly from the UK point of view. In other countries, in the likes of Japan, they've had negative interest rates quite a few times and for a long time in their history. So try and explore the concept of why an economy would have negative interest rates. The simple concept is don't invest with the government debt, invest elsewhere or spend to kickstart the economy. Here you have the London Interbank Offer Rate, the LIBOR rate, which is either overnight up to 12 months, and it's set once a day. And this is the rate that's going to be discontinued later this year, and it's going to be replaced in the UK by SONIA, which is an overnight rate. But at the moment you can see that the overnight rate of LIBOR is 3 basis points, but SONIA's 4 basis points. So if you're going to borrow money, you're more likely to borrow at the overnight low LIBOR rate than the SONIA rate because it's lower. So we'll cover this a bit more detail when we talk about the money markets. But you can go to this function to get all the market rates of interest and also look at the various economic releases that are coming up, because these are the economic releases that may impact the Bank of England's decision when it comes to monetary policy and interest rate setting. And referring to that, we have acknowledged that the nominal rate takes into account these 3 bullet points theoretically, but the nominal rate also incurs the base rate, and the base rate is the one that is determined by the Bank of England monetary policy based on various economic conditions. So the nominal rate takes into account the real rate. So you may be familiar with this guy. This is Andrew Bailey. And Andrew, he took over the job of being the governor of the Bank of England on the 16th of March 2020. He took over from Mark Carney, who was in charge throughout the whole Brexit debate, as well as the start of the global pandemic. He actually extended his tenure to allow for the Brexit negotiations to continue, and then, following his tenure, Andrew Bailey was put in charge. Previous to this, he was head of the financial prudential regulator within the Bank of England, so it was his job to do prudential regulation of the financial system, but then moved up to be the governor of the Bank of England. And he heads up obviously the Bank of England, but also the Monetary Policy Committee. And the Monetary Policy Committee, they used to meet once a month to decide interest rate setting, but quite recently they decided it's not worth meeting every month. So instead of meeting 12 times a year, they meet the likes of 9 times a year now. If we have a look at the historic trend of the Bank of England base rate, the real rate, you can see right on the far right that at the moment it is 10 basis points, and that is the lowest point it's ever been in the history of the Bank of England base rate. And this is going back to 1911. You can see the historic change throughout this chart, and you could potentially go through this timeline and look at various world events, also various political events in the UK up until the financial crisis, which was the last large drop, and then the next drop to the COVID pandemic. Obviously you have a large period of flat interest rates between the likes of 1930 and 1950, where we had the 2 world wars. Following this, you can see as the UK economy started growing, becoming wealthier, interest rates were put up to curb inflation. You can see the erratic changes between the 1970s and the 1990s. Quite a lot of this, from a UK point of view, could be classed as political, and you may be familiar with the Thatcher period within the UK and what that did and the revolutionary changes she tried to make to the economy to be more technological rather than manufacturing and mining. And during this period, interest rates were potentially lowered and put up quite erratically to curb the economic conditions, and as you can see, quite spiked up above 15% at one point. But really until you got to the early 90s, this is where successive governments aimed to try and lower this variability in interest rates. This was kind of achieved by giving the role of the base rate setting to the Bank of England. Prior to that, it was actually set by the government, so to give that impartiality. Because if you think, if the government can set the interest rate, but the government is also the people that borrow, then there's a conflict of interest there. And certainly under the Tony Blair government, when you had Gordon Brown as Chancellor, there was regulation put in place, certain market acts, which really mandated the Bank of England to control inflation using the 2% guidance, the creation of a different financial regulator, and really aiming to curb these swings in interest rates. And arguably that was quite successful until the financial crisis of 2007-08, when interest rates globally had to be slashed. And then as you can see from there, they were 0.5%, 50 basis point for a rather long time. In the UK they were lowered again due to the Brexit debate, but from there we've seen slight growth and the economy was improving until the global pandemic, which again resulted in interest rates being lowered. As well as this interest rate being lowered, the Bank of England also has the concept of quantitative easing to help kickstart the economy further. So the reason for lowering interest rates is really to increase inflation. If you lower interest rates, you can follow these various charts, supply and demand and all that, but if you lower interest rates, the idea is that people can borrow cheaper People will not save because interest rates are low, therefore the demand in the economy will go up. People will demand more, they'll buy more, spend more. People will borrow to invest, make their businesses wealthier, and all of this should equal to inflation increasing again, creating and generating wealth. But with interest rates being so low, then what else can you do? The concept of quantitative easing is another tool. And this concept is where the Bank of England literally prints money, but it prints additional money, increases monetary supply. With this money, it goes to businesses and buys the likes of government debt, bonds, or other corporate debt, higher investment grade. They buy that debt from the banks. So essentially it takes the debt from the banks, puts it on the Bank of England's balance sheet, gives the banks cash, and then they can use that cash to lend out to the economy. So they buy in government debt or corporate debt from the financial services sector. Again, that's why they're a key player in the diagram we discussed in week 1. And then they use that extra money that's been printed to go ahead and lend out to the economy to try and kickstart the wealth generation process. Next week we will discuss the concept of foreign exchange rates. The base rate itself does have a good determinant on the direction of the exchange rate of the currency. For example, if interest rates go up in a country which is higher than another country, then investors from that country will do what's known as capital flight. They will potentially come to this country, they'll buy pounds to invest in our higher rate products. Because they're buying pounds and selling off their currency, that pushes up the value of the pound. And to finish this lecture, we're going to briefly cover the determinants of interest rate from a theoretical point of view. So the theoretical point of view of the real rate. And this is determined, as I mentioned numerous times, by the concept of the supply of money and the demand of money. And where they meet, you have the equilibrium. To get a better understanding of these theoretical concepts, I'd highly recommend that you do read Chapter 3 of Webb and Bramah from page 55, because that explains the theories, the assumptions behind them, and the characteristics of why this demand or supply will shift. But to briefly summarise, we have the concept of loanable funds theory, which is an extension of Fisher's classical approach, and then we have Keynesian's liquidity preference theory of why the real rate is set. So first of all, we have the classical approach before we get to loanable funds theory. And this concept is about the supply and demand of cash for loans. So this is about loans, the amount of loans that are supplied and the amount of loans that are demanded. If you have more supply for loans than you have demand, then the interest rate will drop. But the classical approach is very simple in that when it comes to supply and demand, the classical approach just says that individuals, they either save or they consume. So they either save money or they consume it. And that impacts the level of supply. On the demand side, they just think firms borrow to invest. So the demanders are just borrowing to invest in positive, profitable investments. If it's an organisation, they might get a loan to buy a new machinery to make their business more efficient, for instance. So it's just a concept of individuals either save or consume, while firms just borrow to invest. The big thing missing from this is the concept of the government. And as we mentioned in lecture 1, a government, it tends to be the biggest demander of funds. So the loanable funds theory extended Fisher's classical approach to introduce the concept of the government being the biggest borrower, and they typically, in an economy that runs a deficit, the biggest borrowers. But also this assumed on the supply side that individuals may just hold cash, so kind of a little surplus. So they don't just spend all the money that they have unsaved. They may hold cash as well. So on the supply side, the amount of loans that are available is dependent on the amount of consumer savers out there and how much money is actually saved rather than consumed or held. You can see the formulas here that the demand is actually based on how profitable investments are. So net investment plus additional liquidity reserves will determine the demand. Essentially saying an organisation will only demand a loan if they are able to make a profitable investment from that loan, as well as have additional liquidity in reserve in that firm or organisation. And on the supply fund side, the formula is all the savings plus any increase in money supply from the government. It's also quite a short-term concept because it doesn't really assume any time preference. It assumes that people save now, or if it's on the demand side, that they demand now and they demand to consume immediately rather than holding. And certainly on the supply side, the rate does take into account the concept of deferred consumption because you're saving and not holding or consuming. That's definitely taken into account on the supply side. As we noted, the demand for loans really depends on if it's a profitable investment. I'll show you that in a second on the chart. And obviously the supply of funds, it really depends on how much cash people actually have to save in the first place. So if everyone's in a wealthy position, then there may be more cash to be loaned out. But also, the interest rate itself is a determinant of the supply. If interest rates are quite high, then there's going to be quite a lot of savers trying to save. But if interest rates are quite low, then there's not going to be so much savers to save. Thus, an equilibrium will determine the appropriate rate. If we plot that on a chart, it does look like a typical supply and demand chart where supply and demand are both sloping. So if we have a look up here, we think on the demand side to start with, if the equilibrium is 5%, up here on this side of the line, if the company has a project or an investment that's going to yield greater than 5%, then they're going to potentially get the loan because this is where the supply is. Equilibrium is at 5%. If the projects that they're looking to invest in will yield a more efficient and higher rate of greater than 5, the company will invest. But if the project returns lower than 5%, of course they're not going to take the loan. Why would you? You're going to make a loss. If equilibrium is at 5% and the likes of a lender offers to give you a loan at less than 5%, you're more likely and willing to take it. On the flip side, if equilibrium and the real rate is 5%, then if someone offers you an interest rate greater than 5%, you're not going to take it. Why would you? When there's cheaper rates at equilibrium out in the market. So you can imagine why the likes of this rate will change. So if demand shifts, and demand would shift if there's lots of profitable investments out there. So if demand shifts but supply stays the same, then of course the interest rate that should be charged, or the equilibrium real rate that should be charged, will increase. If the rate does increase, then what will supply do? Potentially this might change even further because if interest rates have gone up, then potentially you may have more savers and the supply of savings may also increase. But if that does happen, then the savings line will shift to the right, will actually mean the rate would actually drop, or equilibrium would become less if supply shifted to the right. So it's a very dynamic diagram, and if demand shifts and supply stays the same, then we may actually see, well actually supply should change because supply is dependent also on the rate. If the rate is higher, you're going to save more. If the rate's lower, you're not going to save more. So supply would be lowered, and so on. And the next concept is the liquidity preference, or what's known as monetary theory. And this is different in the fact that it's about the supply and demand for cash. Not loans, but cash. And it states that supply of cash is fixed. Who's it fixed by? It's fixed by the likes of the government, or in this case in the UK, it's fixed by the central bank. And monetary supply only changes if the likes of quantitative easing takes place. So it's more about the demand side, and this demand side is sloped, but it's about the demand for money, the demand for cash. And we only demand more cash if we become wealthier. If we get paid more, then we need more cash to store that additional payment. As wealth grows, we need more cash to sustain the generation of wealth. But if supply is fixed, so the amount of cash is fixed, and more people are demanding additional cash to store the wealth that's being generated, the additional pay they're receiving, and so on, then what you'll see is demand will go up, but money supply stays the same, it's a straight line, as you can see from the diagram. Then an interest rate would have to go up. So the demand for cash goes up because we're getting wealthier. In other words, inflation's going up. If we then start demanding more cash, but cash is fixed, then the interest rate would go up. And because the interest rate goes up, then arguably people will stop demanding more cash. Because if interest rates go up, that potentially slows down aggregate demand in the economy. People might save more and not spend more, and if people are not spending, that pushes inflation down. Therefore, if we're not spending because inflation's dropping, therefore the demand for cash will also drop, in this case back to R1. And if interest rates, for instance, as at the moment, are very low, then the only way that potential inflation can be curbed is to start moving the monetary supply line. Please do have a read of this summary table that gives you a comparison between the loanable funds theory and the liquidity preference theory. This table obviously does not acknowledge the classical approach, which turned into the loanable funds theory. So do have a look at this diagram in more detail, but to get a full understanding of the concepts I've just mentioned, do go to chapter 3 of Webb and Brahma and have a read in more detail, and that is part of your directed study. I also recommend that you go to the website for the core textbook, which is also located at the bottom of the topic diagram in chapter 3, and on there is some various multiple choice questions to challenge your understanding of the concepts I've mentioned. And then do have a look on Bloomberg to go through the BTMM, look at yield curves, try and explore yield curves from different countries rather than just the UK to get a sense of why interest rates differ around the world. And you might be interested to look at the case study of Japan that's had negative interest rates historically quite often. I hope from this lecture we have a good understanding of what the purpose of interest rates, who sets the likes of the real rate of interest, and then how that is reflected in nominal terms when we go at the consumer, and that we take into account the various theories and reasons why the yield curve has its shape to go from the real rate to the nominal rate. So do have a read through chapter 3 of the core textbook and have a look at various other interest rate chapters from the books on your reading list. Thank you very much for watching this lecture.